Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder. Welcome back to another ETF Spotlight. Today we are joined by Shana Sizzle, CEO and founder at Bonrian Capital Management. How are you doing today?
I am great. How are you doing?
I'm doing well. First things first, I noticed the hat in the background, all in on alts. Today we are going into the alt ETF space, how it's kind of come to such popularity. Actually, let's start there. How did you see this rise of the alt ETF space kind of become what it has become with the funds just increasing into that specific area?
So a couple of things that are interesting. If you actually look at the history of liquid alts, meaning there's a lot of different definition for liquid alts, but when I use it, I mean mutual funds and ETFs. So the SEC changed some of their rules as it relates to the 40 Act in 2007. And it led to this huge uptick of liquid alt mutual funds. Everybody who was around then might remember every major asset manager had a 130-30 or a 120-20 fund. That was all a result of the changes to the 40 Act rules as it related to leverage and shorting that allowed for the proliferation of liquid alts. But then we went straight up for like 15 years. And a lot of the funds that came to market during that time closed. And so for a while, it was actually quite hard to find liquid alternative products because there wasn't a lot of money going into them. So a lot of the firms that had started and had really interesting product in 2007 closed those strategies because they weren't gathering assets. Then fast forward to 2019 when the SEC and many of the asset managers were lobbying for this, changed some of the rules as it pertains to being able to bring active ETFs to market. And then you saw these liquid alternative ETFs come into the space. It's still quite small. There's actually only a couple hundred alternative ETFs, but it's growing. And that is because we've had these very volatile markets. Since 2022, alternative strategies have actually been working. And people have been talking about alts and the importance of alts, and that has really driven these new products into the market.
So how are investors looking at the ETF space? They all know about the passive side of things. Everybody's taught about the heavy hitters on that side of the front and how they kind of work it into their portfolio. But when it comes to an alt ETF, what should investors keep top of mind when they start exploring which alt ETF might be right for their portfolio?
So I think there's a couple of things that you need to be aware of. Number one, the legacy research providers like Morningstar and Lipper don't really categorize these products in a way that makes them easy to differentiate across what strategies should be in a portfolio and how they complement each other. I'll use an example. To Morningstar's credit, in 2021, they did introduce new categories to help bring alts into better categorization. But I've always argued that Morningstar and Lipper should have talked to HFR or Credit Suisse or one of the firms that was already doing a lot of hedge fund categorization and try to align with the existing hedge fund categories because it would have been easier for investors. But they didn't, and that's fine. But it has led to some obstacles as investors look at these things. First things I'd like to note is that you really have to look at nuance here. If you're an advisor who typically uses Morningstar for your searches and you look at large cap growth, you can very quickly and easily build a screen to find the best products, and it is like to like. But in the alts world, that's not the case. So you want to look at, if you build a screen, the way that certain strategies sort of clump together. And what I mean by that is if you look at, say, the options-based category, the options-based category includes everything from covered call options to derivative income, although there is also a derivative income category, or there was. And so some stuff ends up there, some stuff ends up in option-based. It gets a little bit cloudy. Tactical allocation includes some macro funds, but so does the macro category. And so it often makes sense to try to speak to somebody with specific expertise, because what you want to make sure you're doing is that you don't go and look at, say, options based and just run a screen and say the market's doing well. All the covered call options will be at the top. The covered call strategies will be at the top, and at the bottom will be probably your buffers and anything that's, risk managed with using puts or anything like that. If you look at market neutral, it's going to be based on specific market conditions, because market neutral usually is playing on a specific factor. So you really want to look at these things more nuanced and do a lot of analysis of how these things actually correlate to equities and fixed income. You want the lower to no correlation options, your managed futures, your global macro, your market neutrals, and your long shorts should be directional, and you want to look at their up-down capture. So you want to have an asymmetrical up-down capture, but you're going to have more equity beta there. And all of those things you need to really consider when you're building these portfolios. It is a lot harder. It's not as easy to just pick the best one at the top of your screen and go. You have to do a little more analysis. And so sometimes it helps to bring in someone like myself and other firms that do this work to kind of help you differentiate and build those portfolios.
Now, a follow-up question here. When investors are looking at these alt ETFs, what would be a reasonable expense ratio that they should be anticipating having to pay out to partake in these funds?
So that's a really great question, because there's a lot of confusion as it relates to expense ratios for these types of products. I like to point out that there's regulatory reasons why these expense ratios look really high. So if you look at some of the funds by, say, Cambria funds, or you look at Rareview Capital's closed-end arbitrage fund and some of those others where it's a fund of funds, the expense ratio is going to look really high, but it's absorbing the expenses of the underlying ETFs and the expenses of themselves on top of each other. So you kind of have to think about, it's not 5%, it's more like whatever the management fee is, and you have to go look at the prospectus. If you're looking at anything that's physically shorting stocks, the regulators require that they include in the calculation for the expense ratio things like the cost of the dividend paid and the cost of shorting, so your margin interest rate. But that's also calculated in the actual NAV of the product, right? Because that's how you figure out the value of the underlying stock that you're short. So it's actually phantom. So again, you got to go to the prospectus, and I'll use BTAL as a perfect example of this. It's the AGF U.S. Market Neutral Anti-Beta Fund. If you look, I think it says their expense ratio is 1.45%, which is actually on the lower side for an alt ETF, but it's still higher than your traditional ETF. But if you actually look into their prospectus, you'll see them remove all of those, and then they have a rebate, and it's actually the actual expense ratio of the products is 45 basis points. So you really do have to look. If it looks really high, you want to look at the prospectus and make sure that you understand what's in the expense ratio. For alt funds, it's always going to look higher, just because it's a little more expensive to execute these strategies, but it's almost never as high as it looks on paper. A lot of these alt funds have to include calculations that are basically phantom calculations. As I said, when we talked about Cambria, they're a fund of funds. So again, the cost of the expense ratio to the underlying ETF that they're invested in within the fund is also calculated in the value of the ETF. So again, it's a phantom cost, but you do have to be aware of that. So before you have sticker shock, you have to go and look at the prospectus. It's almost certainly not as high as it looks.
Thanks for pointing that out. Now, Shayna, I wanted to ask you, so the majority of the market, we see year after year, passive is taking over more market share. Do you think that makes it harder or easier for these active fund managers to execute strategies?
Well, it depends. In the alternative space, I think I would argue that it makes it easier. It's harder in the active space because you don't have the toolkit that somebody who's doing shorting and derivatives has. And so the ability to use leverage, albeit with limitations under the 40 Act, is a useful one. But let's look at an ETF like CBLS, which is the CLOW Hedged Equity ETF. That's an actively managed long-short fund. If you look at it as a long-short fund, it's pretty impressive. It's also actively managed. Really good stock selection. It gets almost all of the markets up and it does have really strong downside protection. And that is an example of an actively managed fund where the shorting is a little harder to do systematically. And so some of these strategies actually benefit from the actively managed aspect of it. Shorting is really hard, even if you're only using a quant screen. But it's one thing to consider. But then on the flip side, a lot of these strategies are passively managed. So I mentioned BTAL, which is BTAL. That is actually managed to an indice that has been created for them. And it's just, it has very clear, it's rules based, and it reconstitutes on a regular basis. So you know kind of how it's going to work. But that's pretty passive. And then you look at, say, managed futures or things of that nature, those tend to be pretty passively managed as well. So they're all typically rules based in this ETF area, but when it is actively managed, like a cloud capital hedged equity, you want to pay attention to the fact of the skill of the manager on picking longs and shorts.
Yeah. Now we've been talking for quite a little bit here, but I want to know, where do you think the alt ETF space is headed from here? What should investors be watching in the future? Is it more regulation change? Is it more funds? Any thoughts?
So I think there'll be more funds, but I do think that the alt category gets used a lot for marketing purposes. I don't want to call out any particular asset manager or issuer here, but I'm seeing more and more, say, buffer ETFs that are really just a marketing wrapper. There's a Bitcoin buffer that makes zero sense to me. It's got like a cap on upside of 10% with no downside. But then when you think about what you want your alts to do, that's not it. You want your alts to have low correlation, to not necessarily be performing well when equities are well, or well when fixed income. You really do want it to have a return pattern that's going to complement your other ETFs. So you really need to look at them with that in mind. When you're building the portfolio, you do want to pay attention to like correlations with traditional markets and excess return correlations across the different alt categories. You do want to look at things like how they complement each other. I know there's been a lot of discussion about BTAL versus managed futures and how managed futures look better, but they're two dramatically different strategies, and they actually don't correlate well to each other at all. So they actually complement each other. So it's not an either or, but a and. And so you got to think of all of those things, and you got to understand that these alt ETFs are going to do hedge fund like strategies, and they're going to be doing trend following. They're going to be rules based in many cases. If they are doing active management, you want to pay attention to the manager skill. And all of those things need to be considered. But as far as the industry goes, I think we're seeing more and more product come out, which I see as a good thing. But a lot of it's just, carefully packaged marketing. And so as an investor, these new products that are coming out, you really want to pay attention. Is it really an alt? Does it really bring the benefits of alternatives to your portfolio in terms of diversification? Is it liquid? There's a ETF coming out that's private credit, right? And the sponsor says that if there's ever a liquidity problem, they will provide liquidity. But like, at what point will the fund size get so big where it would be difficult to provide liquidity for the private credit? And if they can't provide a ton of liquidity, that means that how much actual private credit in the fund is there? It's probably pretty limited. So is it really private credit? You got to think about all these things, because again, a lot of it is just really well packaged marketing, and you really want to think about those things. Remember, ETFs cannot close like a mutual fund. So when you're dealing with illiquid assets like private credit, for example, that matters. It isn't liquid. It doesn't offer daily pricing. And so there needs to be a liquidity provider that can support the assets in the fund. And if it grows too big, even the biggest asset manager would have a going concern if they were the sole liquidity provider.
Yeah. Now, so you brought up private credit. So I've got to ask you, personal opinion, is it really a good idea? Do you think it's a good idea to bring private credit to the public markets in some sort of wrapper like this, or should private credit remain private credit?
I believe private credit should remain private credit. The second you start bringing it to the public markets, there becomes more and more pressure to market. And the reason why private credit has the attributes that it does is because it's private. Also, keep in mind that private credit really came into its own during the financial crisis because banks were not providing credit to a lot of companies. and a lot of individuals. And so this alternative market of private credit came to be, and it serves a really important purpose within the capital markets that have changed drastically since the financial crisis. And if you change the underlying attributes of private credit so that it can be in the public markets, well, then it's not private credit, it's public credit now. Maybe it has some, flash to it, but it's not private credit anymore. The reason why private credit can do what it does is because it's private. And some things, same thing as private equity, need to stay in the private markets to continue to bring the attributes that they do in terms of the return profile. But more importantly, the role in the capital markets that they play is important, and we want to be conscientious of that.
All right, Shana, let's go ahead and leave it there. Thank you so much for giving us your great insights today. I could ask you a ton more questions, but obviously want to be mindful of time here. Hopefully we can have you back on here soon enough on ETF Spotlight. And thank you for watching, everyone. We'll see you here next week.